the week at 19, and 3 months later was trading at $35. So here's a terrific opportunity to take advantage of all of this uncertainty and all of this panic that's in the market to start buying stocks at very cheap prices.
There is a value approach to valuation, and this is really what distinguishes it more than anything else, starting to look at the balance sheet, which most people don't look at. Most people project earnings. What Buffett has added to this is a systematic way that's much more intelligent than the standard valuation approaches for looking at growth stocks. A good valuation approach will also clearly identify the critical information that you are uncertain about and that is going to focus your research effort.
When you add bad information to good information, what do you get? You get bad information. It's not a good way to go about trying to pin down a value.
So it's in the area of how you look for stocks, how you value stocks, how you focus your research and collect all the relevant information, and ultimately how you analyze and manage risk and construct a portfolio. That value investing is very different from almost all other current practice. And the evidence that it's successful is that if you look at, in every dimension, what investment strategies are successful statistically, overwhelmingly they're the value strategies, and modern financial academics have established that beyond a reasonable doubt.
You want to go to the part of the market where other investors are crazy, either crazy on the optimistic side if you're a short seller, or crazy on the pessimistic side if you're going to just be buying stocks. So you've got to look intelligently for those opportunities. You've got to ask, where is the craziness today?
We think too much in linear terms. It's very often that investors will go to their advisor and say, I want 10% a year. Unfortunately, 10% a year does not happen in reality. In the last 100 years, a 10% return has only occurred 8 times in the last 100 years. It's more important for investors to take the scope of markets over time and pay attention to the fact that they may have a range of returns based on their asset mix. So for example, if you have 100% invested in equities, you should have an expected return in any one year of plus or minus 20%. The fewer equities that you have, then of course the expected returns are going to be lower. Try and get away or avoid the idea of trying to make 6, 7, 8% every single year. It just doesn't happen. It's not reality.
That, as Graham says, you want to focus on risk before you focus on return. Some of that comes from the worrying that George described in his introduction. A lot of it is focused on multiple scenarios. What can go wrong? How much can you lose? You know, we don't think of risk in an academic sense of beta, which doesn't make any sense to us at all. Volatility is not risk. Volatility is volatility. Volatility creates opportunities and isn't necessarily a risk at all unless you absolutely needed to sell the day that the price was very low. Rather, risk is the probability of losing and how much you can lose if you lose. So we focus on risk before we focus on return. That's obviously very different from Wall Street, where they still, even after pressure, write a huge percentage of research reports that are bullish, very few that are bearish. And even when they do think about other scenarios, they tend to oversimplify with single point estimates rather than a range of possible outcomes. And in other words, inevitably are focused mostly on how much you can make. And with a spur.
Volatility actually is the friend of long-term investors. So it's what creates the 50-cent dollar bill. You know, we say that we're supposed to buy 50-cent dollar bills, but that doesn't happen in a market which is rational and steady and smooth. It's during volatility periods like this that values open up, and that's actually good for the investor. It's not very much fun for the money manager, and the clients are often nervous, but it is actually, first of all, opportunistic. Secondly, our companies are helping us through this period of volatility because it opens up for them a chance to buy back stock. So MasterCard's bought back $1.5 billion worth of stock at $200 and some a share over the last 18 months. It's since the start of this year, actually. That's good. They're able to retire stock at a low price because of the volatility that we're seeing. It also opens up opportunities for acquisitions. Berkshire's made a couple of big acquisitions taking advantage of this volatility. Transatlantic is just the most recent one. SAB Miller's buying Foster's. Nestle's buying the Chinese confectionery company, Chinese beverage company. Our companies take advantage of the volatility.
So it's not so much that we're talking about lessening the volatility, but you're saying that the companies, the type of companies that you invest in, actually take advantage of the volatility.
Absolutely. Yeah. And then for my investors, I try personally, at least with the investors who I work with, to have a relatively small amount of their equity capital. And I advise them before they talk to me to make sure that they've provided for themselves in fixed incomes and other forms of investments, which today, unfortunately, are rather underwhelming because rates are so low in their savings accounts that they're inclined to put more into the market than they should. But investors should keep a dry reserve just for periods of volatility. Otherwise, they'll be shaken out at the wrong time.
Business. I don't want a business that's easy for competitors, so I want a business with a moat around it. I want a very valuable castle in the middle, and then I want the duke who's in charge of that castle to be honest and hardworking and able. And then I want a big moat around the castle, and that moat can be various things. The moat in a business like our auto insurance business at GEICO is low cost. I mean, people have to buy auto insurance, so everybody's going to have one auto insurance policy.
Investing would be practically foolproof if only it wasn't done by human beings. If all that mattered was getting a high return, the obvious course would be to keep things dull, follow proven prudent rules, and not let anything deter you from that course. But we humans are social animals. We don't do anything just for the money, and that's where things get sticky. Mayer Stopman is a professor of behavioral finance at Santa Clara University. His field blends economics and psychology, and he points out that one reason people invest is to express themselves. Men in particular like to be seen as competent at taking risks and having them pay off. We want to be like Jim Cramer or, God forbid, Gordon Gekko because they seem in control. Chairman of the Smart Investors Club. Problem is, especially if you don't invest for a living, there are always